Hello and welcome to this special series, Invest Right, the Future Bright. Joining me today is well-known financial planner Gurmeet Chadha. Thanks very much, Gurmeet. A pleasure to have you here in our studio.
Likewise.
And these are, what should I say, scary times, at the same time exciting times in terms of investor behavior. So let me straight away get to the point about equity. We saw recently the whole sharp fall that has played out in the Sensex, and therefore to tell somebody that it is risky, I think you just need to point towards what we've seen.
Yeah.
But how risky can equity be? We've seen 20-30% kind of falls. Can it be even worse in your lifetime? Have you seen it even sharper? I was reading a quote which says that if you can't let go of 50% fall, then you shouldn't be in equity. Is it that risky? How risky is equity?
So, Vivek, I think saying alone, only talking of risk without risk-reward relationship, I think is being unfair to equity. I think one has to look at the risk-reward relationship. Obviously, on a risk basis, you can see downsides. We've seen 2008, where the index crashed 70% from 20,000 to 8,700. And I think if I recollect early in my career, it was 24th of October 2008. And by October 2009, we were back at about 18,000 on the index. So I think you have to measure risk reward both. I think times like these, there's no point calling the bottom and getting into the timing part of it. Even after this sharp correction we have seen this month and a bit in February, the 5-year 10-year returns still are closer to double digit. The Sensex 10-year return is still double digit. Even the 3-year return on the Sensex is still about. So I think you have to have a little longer horizon when you talk of risk reward relationship. My sense is right now the risk reward is now tilting slightly in favor. It may last a little longer because I'm not a medical expert, so I don't know how this coronavirus will play out. But if you go by the previous outbreaks, which was H1N1, Ebola, Zika virus, we have seen that typically a sharp fall, and once you have some containment in that virus, is followed by a equally sharp rebound. So stay the course, stick with your asset allocation and look at some valuation parameters. These are the times you should go back to the books, the basics. Your market cap to GDP is 60% now, which we call it as a Warren Buffett indicator famously. We were at 56% in 2008 crisis. So while the market has only corrected, let's say 25% from the peak, and we've seen 20-25% correction, valuations wise, you are actually much more nearer to 2000. Those are typically followed by, good medium term returns. So look at valuation, just don't measure risk, look at the risk reward relationship overall.
But if you were to explain to a potential investor that, and the regulator also makes all of us reiterate that equity markets or equity comes with risk. How would you define that risk for an investor?
So there are two ways of defining it. So one is in terms of absolute numbers, that we have to clearly specify that so it has to be linked with the goal and the horizon. So if any goal of the client, and we follow a very asset allocation and a goal-based approach, if any goal is 3 to 5 years, I think equity, then the risk quotient becomes very, very high, and one should be very careful in terms of giving that allocation. But if your horizon is longer, which is about 8 to 10 years, which I just highlighted that despite the fall, so over a longer period, that risk gets mitigated to a large extent. So it mirrors the nominal growth in the economy, which is still with all the stress in last 2-3 years, is still at around 10%. So you measure it in terms of your time horizon and your appetite, and it will vary from individual to individual. So if somebody is dependent on income and earning yield of the portfolio, we define it in time horizon. Shorter the time horizon, the risk goes high. And we also define it in absolute terms that whenever we are giving equity exposure, the client should have the ability to take 30, 40, 50% kind of drawdowns. And those are very normal these days. I mean, every 2-3 years you see events which keep playing out, and which I just highlighted.